Here we are.
Here we are. Another annual.
That's it. Yeah.
My first annual.
Your first annual,
first
yes.
annual.
Yes.
Yeah.
Yeah, the year goes by fast. And yeah, another virtual one. 2 years in a row virtual. Yes.
I know.
Mm-hmm.
Yeah. Ben and I from our basements enjoy, by the looks of it, you're in your dining room.
Yes,
So,
that is.
hey, one above ground. That's pretty good. All right, Ben, how do you want to get started here? It's your show. Let's kick it off.
Yeah, I think we'll probably certainly I got lots of slides to go through tonight, so I'll try to zip through them as quickly as possible. And as per usual, if you have questions as we go along, you want to interrupt, certainly let us know, and you can put a note in the chat or raise your hand, something like that. But certainly I'll leave time at the end as well. But first of all, I wanted to say thank you. Thank you for a great year. Thank you for the support and sticking with us. And we're looking forward to a great 2022. We brought Joy on last year, so we're excited about her continuing to help you and help the team. So we're excited about that. And I think I got a long presentation to take you through. If there's anything that comes up through it, let us know. But let me share the screen. We'll get going with the slides, and I'll have a couple of Go ahead.
While you're doing that, I'll just let people know. I see a lot of the regulars on here, but there are some new faces that maybe don't attend the weekly updates. So if anybody has a question throughout, if you hover over the bottom section of your screen here, you'll actually see a Q&A button. And if you click on that, it'll bring up a chat box, and you can type a question in there. It's probably the best way to do it for today anyway. Yeah, and then we'll kind of filter those in whenever it's appropriate to do so. Might be at the end, maybe there'll be a break in the middle. We'll see how it goes. Okay, Ben, without further ado, you're on.
Sounds good. Great, thanks. Well, disclaimer, obviously anything we talk about today is not investment advice. If you have any individual questions, certainly please let me know. But we're going through a bunch of discussions around the markets, the economy, certainly talk about some individual stocks, but that's the boring disclaimer part. More importantly, we thought we'd take a couple of minutes and just introduce you to the team. I know most of you have had the chance to speak with both Scott and Joy, but if you haven't, we thought we'd have a minute here, just talk a little bit. We've been trying to communicate the best way for you to reach us, either by phone or email. So wanted to give you an example of what you should be calling each of us or emailing each of us for. So if you haven't met Joy, this is Joy. She's come on to help with the client servicing. She is your first point of contact. If there's something you need immediately, you can't reach anybody, I'd be going to Joy first. And so one of the things that we've been rolling out is the new email, which is service.hart@nbc.ca. So that for that point of contact goes to all three of us, but likely you're going to get Joy looking at that, responding first. If you need money in, money out, you need to book an appointment, certainly feel free to give her a call. She has access to the schedule. You can use the booking app as well, but Joy can go in and book something into my calendar at any point. Joy, anything you want to add to that?
Not really. You really touch base on everything, but I have been here now for I think 6 months.
Yep.
And I've already really enjoyed my time, and the couple clients that I have been interacting with so far have been very pleasant interactions, and I'm excited for 2022 and to continue working with Ben and Scott and you guys as well.
Awesome. Perfect. Thanks, Joy. And Scott, so Scott over the last year has completed his courses. So Now he's officially licensed as well. So if you do have any trading requests, anything like that, you can certainly call Scott directly. He has access to entering any trades, transactions, anything like that. He'd be involved with the client servicing as well. So Scott's been calling you and sending notes, I know, over the last couple of weeks, to reaching out to more people that he hadn't spoken with. So if you have any questions, comments, certainly feel free to either email or give Scott a call directly, and he can help you with anything that you need as well. All of the content, all the videos and things that we're putting out, Scott's in charge of making them happen and making the magic on that side as well. Anything you want to add, Scott?
Not really. Just I'm coming up on 2 years here, so that's it's been great. I've talked to a lot, if not most, of the clients by now. There's still a few that I haven't, but yeah, I've great contact with everybody, and having a great time moving forward here, and looking forward to another great year.
Nice, perfect. And me, you guys all know me, so my job is investment strategy, planning, tax planning, things like that. Obviously, Canadian trade as well. So the focus will continue to be on strategy and planning and making sure we get you going in the right direction. That's really all the things we'll be covering tonight. Is what's the strategy, what happened last year, what's going on this year, and so that's what we'll spend the majority of the night on tonight. And so just a couple more slides before we get into kind of the main content. Is you've seen the video podcasts and the YouTubes that we've been putting out last year. We've launched one so far this year. Hopefully you've had a chance to watch that, Stack Capital on private equity. Super interesting. The daily emails come out. And Scott, maybe you want to touch just on the monthly newsletter before we go to the other ones.
Yeah, we've had a bunch of comments, like we've really upped our content game, obviously, over the last year and a half, and not everybody can consume content every day. We totally get it, right? It almost seems like we've been inundating you the last little bit. So we have the dailies for people that want to interact daily, and we certainly have lots of people that do that. But the monthly newsletter is just going to be, we're going to compile kind of the Cole's Notes version, what was important that month, we're going to put links to the best videos that we had, so you kind of pick and choose the best of that month.
That's great. And so we'll set up a way for the clients to sign up to that as well, if they want that.
Yeah, absolutely. So a lot of you may have seen, we've kind of moved to an email service to manage some of these things better. So if you haven't been receiving our emails lately, definitely check your junk mail and be Heart Investment Group, because some of these email services go directly to your spam filter, depending on what service provider you go to. But on there, you'll be able to select what you want to receive. So if you don't want to receive the daily emails, you can unsubscribe to that. We've had some people do that already. If you only want the monthly newsletters, or you want the notification for the podcast, so you'll be able to pick and choose exactly what emails you want to get, because otherwise you're going to be getting a lot of emails from us. So some of you will want them all, and that's great.
Yeah, for sure. Perfect. And we'll continue on with what we're doing with the weeklies and the outlooks and the quarterly commentary and performance. Will continue to come out this year. So I think that's about it. We'll jump on to the next one. Want to get going, moving things along here. Continue to make a couple of changes. As I mentioned, there's our centralized email, which is service.heart@nbc.ca. That'd be, again, your best bet to get us to respond right away. Sometimes I'm in meetings or on the phone on calls, so this would be the best way to reach out to us. Anything you want to comment on this screen, Scott, before I jump into the rest?
No, not like you mentioned. I do want to mention one thing, that we obviously prefer people to use service.heart at nbc.ca, just because that allows us to track what the projects are and what work that you're asking for. But certainly the ones that prefer to call, you can absolutely do that. You can call any of us at our individual lines for now as well.
Yep. Okay, perfect. All right, well, I think I'm ready to go. I think we killed about 8 slides there, so we're good.
I know, that's pretty good. That's a good start. Okay, everybody, we'll enjoy that, and Joy and I will just turn off our cameras there. And maybe Joy mute as well.
Okay.
Perfect. Well, great. So thanks very much, everybody. Appreciate spending a few minutes. We just wanted to give you a chance to have the team say a few things and mention a couple of things that we're working on. But now we're gonna dive into what's happening, what's going on, what happened last year, and what I think is going to happen in this upcoming year. We've already had a crazy start to 2022, markets, interest rates, lots of things to cover and go through. But really, the three things I wanted to focus on today, and what I continue to focus on, is what are the risks in the economy and the markets, what are the opportunities, and really the focus is how do we minimize the risk to maximize the opportunities. And so a lot of things that we're going to go through today, I'm going to discuss really kind of the pros and cons of these three things, and where I spend the majority of my time, at least in the investment side, focusing on how do we get you to your goals. And so those are the three things that I wanted to focus on today. So I think as we've been going through the last 2 years of lockdown, there's been lots of things that I've been thinking about around demographics and how the world's changing, how the investment world's changing, and really, I guess from the kind of the mix between the financial world and the political world, I think demographics is going to play a major part in that. And we're seeing kind of senior leaders right now wanting to continue to go down the same direction, the same way, and continue to keep the control of the systems, either politically or financially. So that'd be the central banks and governments wanting to have control and continue down the same path. And we've seen a major divergence with this kind of decentralization theme, which is some of it's crypto, but it's more than anything, it's kind of this theme that says, we don't want to have control by a select group of people. And so the reason I point out this demographics or this generation slide is, we got kind of a pretty material shift in the workforce happening right now, where you'd have millennials becoming a major contributor to what's happening in the workforce and politically. And I think we're in the early stages of this kind of demographic change. And, I've been talking about this fourth turning for a while, where I think we're in the fourth turning, where you get a massive change and upheaval. And we're seeing a lot of that take place right now. So these are some of the themes that we're going to cover today. And I always like to start with a quote, and a couple of quotes in this case. And last year I put this one up from Jim Grant, which is the key to successful investing is having everyone agree with you later. And so I think part of the point about this is, sometimes when we make investments, I make a decision, I look at a company or a sector, and my timeline might be looking out over a couple of years or maybe even longer and saying, I think this has good potential long term, but your timing sometimes is off. So, why I included the Paul Tudor Jones quote is because he says, the best investors match their investment horizon with their time horizon. And so when you think about that, when you're investing in, for example, a battery company today, where you look at it and you say, well, I might have bought this a little bit early and it's down 10% or 15%, but in the long term, it has a chance to go up 10 times from here based on where it looks like the future is going. So sometimes when I'm looking at constructing that portfolio, I'll be quite focused on how do we position for the next 6 to 12 months with the lion's share of the portfolio, but maybe you make a smaller allocation to some of these bigger name or these bigger opportunities that can create some outsized returns without taking a whole lot of risk within the portfolio. All right, so this continues to be my thesis on how I look at the world. I'm always trying to get better and how I'm making decisions within the portfolio. And so, one of the key things that's always happened is overconfidence is the root of all losses. So you can have 100% certainty that something's going to happen, but the stock market is not like that. It decides what and how and where it's going to go. Bond markets are the same. Cryptocurrency markets, regular currency markets are all the same. So you need to constantly check and recheck your views and positionings. Bad opinions can be very costly. Consensus is often wrong. Last year was actually one of the few off years where consensus was actually right. So I think as we come into this year, the market's truly telling us that consensus is not necessarily going to play out the way that that you'd expect. And being patient and not stretching for short-term returns requires discipline, and often when the best opportunities are presented. So, further to my point about looking at some companies that have outsized returns. So maybe you buy them now, but in 5 years they've gone up 10 times. Sometimes you have to be patient for that. And the last one, which I've added this year, is over trading. So it's something that I'm conscious of, and a couple of the things that didn't work out as well as I'd like to see this year. One of them was a little bit too much trading in certain areas. So it's something that I'm conscious of and checking in to make sure my portfolios are positioned for your goals and your targets. So as we look at 2021, there's a number of things that really happened this year. There's a really low volatile year. There was meme stocks, there was SPACs. We had we had Robinhood and Reddit, and in the first quarter of this year, we reached kind of peak speculation from Robinhood, SPACs, all of these things kind of peaked early in this year, kind of March, April, May. And then what happened and what kind of took the ball for the rest of the year was passive investing. So you had a massive influx out of active managers and into passive. And so when I say passive, it means ETFs. So you had a lot of money going into the S&P 500, the Dow or the NASDAQ, and it was buying, this continued flow of money into these hugely over levered names like Facebook, Apple, Netflix, Google, Amazon. Like if you look at those 5 companies, it drove 80% of returns in the markets last year. And so you had a pile of money flowing into these things. And there's definitely a lot of reasons why, but specifically the majority of money going into markets, particularly in the US, goes into IRAs and 401ks. And so those are automated purchases that happen each month. So that was positive fund flow into that asset class. And I think we reached peak passive in December of last year. And so those are kind of the key points of things that happened last year. So I'll take you through some more details around that, what worked and what didn't in the individual portfolios. Really a look ahead at what I think is happening right now. Obviously, NASDAQ's down about 12% year to date, which has surprised a lot of people, and certainly we'll add some comments around there. Charts and screens and lots of things that I'll go through, and I'll try to take those through pretty quickly here. And any of my changes, we'll talk about Web 3.0, blockchain, crypto, and a few other things as we move our way through. So you'll probably have some more questions as we get into the slides and charts and views, but we'll take you just a little bit about what worked and what didn't last year. So from a positioning perspective, equities, primarily index holdings, as I mentioned, were the positive contributors. Bitcoin was as well, up about 45% in the calendar year. So if you own that for the year, that was a positive contributor. And low quality corporate bonds. So this is junky, high yield, triple B, triple C, things like that. It was a year of buying garbage holdings, and they went up last year. And high growth US stocks. So as I mentioned, those kind of techie names really drove returns last year, and that worked, and that's what worked. So from a positioning of what didn't work, when I look at one of the unique challenges with managing balanced portfolios is that, from a balancing perspective, is you need something that's going to offset the riskier holdings. And so what that is in portfolios typically, or at least in my portfolios, would be government bonds, US dollars. We'd own puts and gold, and these kind of assets should be that counterbalance when the market sells off, and we're getting some of that counterbalance now. But in 2021, none of those counterbalance holdings really supported the portfolio. That was one of the challenges and drags on portfolios. But if you look historically, after a difficult year in government bonds and US dollar, you typically have a pretty strong outperformance in the preceding year, and we're certainly setting up. It appears we're setting up for that right now. So I think some of these holdings are well positioned for what's going to happen in 2022. So as we look ahead and see what I'd expect to do well, at least from a positioning perspective at the start of this year, some of the things that did poorly at the end, as I mentioned, US dollar, government bonds, and gold. You know, we're into that period of time where, you know, I've said it multiple times. If you come on to the weeklies, you'll see I've been saying for a while that I think growth and inflation are slowing together. The speed at which they slow, we'll see, and we'll discuss that in some charts. But it appears growth and inflation are slowing together, typically quite good for gold historically. So that's a really positive. The other things that typically work well in this environment would be utilities and consumer staples. So from a change perspective today, we did own XLY, which is consumer staples or consumer discretionary, sorry, which I'd switched out into the US 10-year bond before the market sold off today. Just a repositioning, continuing to adjust to what the market's giving me. The other thing that we bought today was NASDAQ puts before the Fed announcement today, and clearly that was the right decision, but we'll see over the longer term, but starting to buy some protection because I think there's more slowdown to come. Added an alternative asset as well, which is Waypoint Partners. And so Waypoint is a income asset that generates consistent returns. In 2020, February 2020, when the markets came down, they're actually up about 3.5% that month. As I speak with the team there, they're very well positioned for any type of correction that we could see in the markets, and really happy with that addition to portfolios. So in the events of the year, I mean, this was continued to be the year of central bank stimulus. You know, we look back to 2020, and you think it was a lot of money that they put into the world and the markets in 2020, but 2021 was by far the biggest growth of, you know, money coming in from central banks, from government stimulus, from checks into people's bank accounts. But it was really 2021 was the year of pumping money into all markets and all asset classes. And we also had the big kind of up and down with the variants from COVID-19. And, you know, we're not going to talk too much about COVID tonight. I don't want to go into too much details on it. But you had these kind of continued open and closing environments, and, you know, as we get down to the end of it here, it looks like we've kind of passed at least the worst of it from the perspective that the world gets shut down. The variants continue to look like they're a little bit tamer, and the different countries evolve and decided to do different things, but it looks like we're getting to the end of that. And so we're likely to see a little bit more of a smoother, I would say, ride from a numbers, statistics, economic perspective. The other thing I mentioned is peak passive investing and uprising. So we're starting to see uprisings everywhere in the world. You know, COVID certainly put a lot of pressure in places. You know, Australia was one where you had, you know, people, you know, kind of flooding in the streets, and they sent in the army to send people home. And right now, more seriously, we have Ukraine and Russia right now deciding on what course of action they're going to take. Russia's rattling their sabers, and I think it's a bit worrisome. And, you know, one of these things that we talk about is, you know, on the surface, it looks like it's just they want the land grab. You know, I think Russia and Europe, I think, are having an issue with maybe kind of the flow of natural gas. And, you know, oftentimes these kind of uprising are much more driven around economics than anything else. So I think it's an important one to pay attention to, and caused an additional amount of uncertainty, at least in January here. And so that'll be something to continue to watch. And so as I talk about central banks, we're rates stuck at zero. Like I put this in the presentation last year, and we are at 25 basis points in Canada. And for those who watch today, central bank came out again, Macklin, and said that we're not going to raise rates. And so I read our national bank's notes and many others' notes on this, and they said, well, we're still certain they're going to raise 5 or 6 times in Canada, which completely floors me when I look at the data. But presently, right now, the market, I think, sold off first from the Bank of Canada and second from the Federal Reserve. But the Bank of Canada said that they're not raising, but I'd say it's a certainty they're going to raise in March. I'm not sure what they're waiting for because the market's already priced in 4 times, but here we are 2 years later, still stuck at 25 basis points. And so this has caused, a bubbly real estate market in Canada, as well as many other things. So it's hard to believe we're still stuck there. So I'll try to rip through a few more of these, but one of the things that I think that's quite interesting is that in 2020, where we saw the world contract and saw CO2 emissions drop dramatically, it's interesting to see how quickly that can happen. And I think there's a lot of technologies and a lot of this remote working could actually bring some pretty positive influences in the world getting to a kind of climate change and thinking about what the future could look like. So there's some really positive things that I think are coming. Wanted to look a little bit about Canada, US, and maybe China as an example, because there's lots of talk about getting to, could say, net neutral is the big talk here. So this is where Canada gets its resources from: oil, hydro, natural gas, and still a little bit of coal. And if we look at and contrast that against China, this is where China is today. And so nobody wants to force the emerging markets. Nobody wants to force China to do anything. But if you look at it, this is a big world polluter right now as they continue to grow and industrialize, but they still do use a massive amount of coal to generate energy in the world. So this is a real issue, but something that I think the world needs to continue to look at and address. The United States as well, they continue to consume coal and natural gas and oil, but so these are things that I think have some longer term ramifications, but something worth considering and paying attention to. So as we jump into the charts and the view, in 2021, we had, as I say, valuations exploded higher. So we reached in these tech names similar levels that we saw in 2000. Generations are kind of splitting, as I say. Demographics are playing an interesting role. Jobs. We've reached a point where it's difficult to get people back to work. There's tons of jobs available and not a lot of people want to fill them or are filling them. So the kind of jobs that are available aren't certainly the best, but jobs continue to be an issue in both Canada and the US and other places in the world. And I'd say the big kind of 2 pieces that have been all the talk about economic perspective now would be inflation and interest rates. And so we're going to go through some of those slides, but those would be the kind of the key 2 things that the world seems to be worried about today. And so I mentioned the fourth turning a few times, and I think if you haven't read that book or read a summary on it, at least it's worth having a look, because I think we're in the middle of that, and it is a challenging time. But on the other side of that, there's tremendous opportunity. So I'm excited about what's coming on the other side. But right now, I'm focused on how do we protect and make money over the next 6 months, because I think we have some serious headwinds to pay attention to here. So, this is the view of the S&P 500 last year, and so one of the things I've spoken about in past years is how did the returns come? Where did they come from? Was it just from growth or multiple expansion, or how did we get to where we are? And not surprising, the biggest amount, or the largest amount, excuse me, was from buybacks. So if we look at kind of the explosion in share buybacks, we've talked about this a few times, but what does that mean is, most of the executives, instead, if they don't know what to do to deploy their capital, for one, they'd be buying back shares of their company. And so we had a massive amount of share buybacks. And if we look at the Canadian banks in Q4 of last year, they got the green light to do share buybacks, and you saw the banks rip into the end of the year. They've given a lot of that back now, but it was all kind of share buyback related, just that electronic buying and bidding up the price of companies. So I think that materially dissipates this year, but a big chunk of that returns came from share buybacks and multiple expansions. So just wanted to have a quick comment on that. And so we talk a lot about interest rates, and I've had the conversation quite frequently with people just about why do I keep saying that that rates are priced in. And so this is a visual of what that means. So as we came into the end of 2021, excuse me, the world was prepared for some interest rate increases, but all of a sudden we had this big push, and central banks started kind of noting that they're maybe going to get a bit more aggressive on rates. And so the Bank of Canada was actually one of the first that had mentioned that. And then the FOMC mentioned it. And so you had a massive uptick on the short end. So the central banks control short rates. They don't control the long end of the bond market. So what happened is we saw rates go from, yes, we're likely going to raise 25 or 50 basis points to 5 or 6 times potentially in Canada. And so you saw short rates explode, and they've already moved now. So my point about the Bank of Canada, why didn't they raise rates today? The market's already priced it in, is prepared for it. I'm not sure what caused them to change their view or stance, but obviously something either in the data or something that they saw or talked about somewhere else kind of made them say we're gonna stay on hold for a while. And so if you look at what this is really the dot plot. So the Federal Reserve in the US, they give their forecasts on where they think rates are going to be in the future. Typical economist, it's a straight line up to the right, which never happens, but that's how they do it. So this is their forecast. These are the members, and essentially the media is saying, the dot plots say that they're going to raise rates 4 times this year in the US. Now, I think it's impossible based on the data, but that's what the market is saying at the present time. And as my view is different than what the market's showing, that's where the opportunities are presented, and important to focus on what those are and where they are. So what have we seen to start the year, and why do we care about this quantitative tightening or quantitative easing? And so why do we care about what the central banks are doing? Well, this is a pretty material preview of what happens when they tighten financial conditions. And so what that means is, right now the central bank, they've been buying assets, they've been buying bonds, mortgages, and anything that they can in bond land to kind of provide some support, I'd say, for the economy. Additionally, they've been further pumping money into the commercial banks, and the commercial banks are supposed to be lending that money out in the form of mortgages and loans and things like that. In some cases, recently accelerated in that, but in more cases than not, they've been lending out to hedge funds, institutions providing leverage for assets and asset purchases. But this is a zoomed out view of what quantitative easing is on top of the S&P 500. So the blue line would be representative of the how much the balance sheet's expanding by the central bank, and the red line would be the S&P 500. And so that's a simplistic. We've seen a little bit of a downtick, but if we zoom in to what that looks like, which I will here in the next slide, it gives you a picture of how dramatic when they start to talk about pulling liquidity out of the system. If there isn't an additional influx in purchases or loan generation or anything like that, you get a pretty material correction, which was what we've seen so far this year. So as liquidities come out of the system, this is what the S&P 500 has done so far this year. So this is a zoomed in view of what happens as quantitative tightening starts, and something that I'm very conscious of and concerned about. But it's a quick look at what happens and why the central bank's liquidity is so important for this economy and this market to continue going in the direction that it's going. So as we look about volatility, and I've had lots of conversations around volatility, particularly last year, because there wasn't any. We had that period where we kind of stayed below 15 volatility for most of the year. And so it seemed like everyone was a genius. And so in a low volatility environment, there's nothing to worry about. So lots of cross currents and signals going on right now. We have volatility kind of in that 30 range, which is double what it was last year. As we get into looking at kind of the volatility curve, so we're in a period where volatility has backwardation, and historically this has been a signal that you buy the dip, which BTD stands for, which is you buy the dip on this signal. So, this isn't something I'm doing right now because I think this is a false signal right now. But you've had a lot of narrative around saying we should be buying this dip because things are going to accelerate from here. So lots of cross currents, lots of signals to pay attention to. And this is part of why I haven't further reduced risk, because I do think likely we see an uptick in the next couple of weeks as the market digests what central bank said today. So I put this up last year, this chart, and it continues to look quite similar. This is a view of the S&P 500 from the perspective of these 5 names, which I mentioned. I think we could put Netflix onto that and take another big piece of that pie. But these are the 5 companies, market cap relative to the rest of the other companies in the S&P 500 there. So it just shows you how much skew we have. And so we've seen this before. We saw this in 2000. We saw, Nortel, JDS being a majority share of the TSX. Nokia in Finland was a giant share of the company, and what happened, or of the index. And what happens is you end up getting kind of material risks within the system. And so this is when I talk about kind of peak passive has driven the returns of a lot of these stocks, and something that I'm quite conscious of. So as we go into the next few here, I'll start to kind of zip through a little bit, but this fear and greed index right now, we're in kind of a fearful bucket, not an extreme fear, which is a bit surprising given what's happened to start the year. There's also a fear gauge with crypto, and so we're reaching kind of extreme fear there as well. And so as we lined up kind of into the end of last year, and as I talk about liquidity being a big driver of returns, we reach kind of peak margin debt, as we look at this has typically been is a signal to pay attention. That's potentially risk of a downside, and so that's what's actually happened to start the year. Just a couple more things on there. This is a view on kind of earnings and forward guidance. It's been the first time, this was recent chart, so January 22nd. So the first time forward guidance is reduced lower. And so again, these tend to be future signals to pay attention to, and something that we should be conscious of. One more here on volatility. We've seen this. We reached a high level. Again, something to be conscious of. I think there's increasing risks happening in the system, and the central bank seems to have stopped talking about kind of the market risks, and so that's something that we need to be conscious of. And the question is, have we entered, or are we entering a bear market, or is this just something separate? And so, as I say, some of the issues where people start talking about raising interest rates, and so, there's often the question about, well, we need to combat inflation. If you listen to Joe Biden, or if you listen to many other politicians around the world, they're really talking aggressively now about combating inflation. Well, on the one hand, they seem to forget that they have massive debts outstanding, and so if you look at the U.S., this is U.S. federal debt by the public as a percentage of GDP. We're at historic highs. So they have the most debt that they've ever had in history, all of the governments of the world. And so I'm not sure how they think they can actually raise interest rates to the point where we kind of normalize rates and combat inflation. So I think that they're a little bit unclear of the objective of what they should be doing. So this is just from a debt perspective. If you look at the U.S., their U.S. national debt right now is about $30 trillion. So that's about 90,000 per citizen. And federal debt in Canada is 1.2 trillion. So that's around 31,000 per citizen. Why is that interesting? It's a huge number that continues to grow each year. I went back and looked at what the debt was the year I was born, and it looked like I only owed about 1,000. My share was only about 1,000. Now we're at 32,000. I know I'm getting old, but it's a big number and it's growing quickly. So, as these central banks talk about raising rates, I don't know where in their right mind they think rates can go up, because this is going to put tremendous pressure on themselves with the debt loads that they're currently carrying. So as we look at what's happened in Canada and certainly Australia, a little bit in the US, but as everyone likely knows and sees, the Canadian housing market has exploded over the past 2 years. And as the previous point that I mentioned, we're at 0.25% overnight rate in Canada, and their politicians and planners say, I don't understand why the housing market's gone up so much. If we keep rates pinned at zero, it's one of the few places that the average person can take massive leverage, 95% leverage in most cases. They only need 5% down payment with 95% leverage and borrow essentially for free. And so we've seen a massive explosion in the Canadian housing market. And as you see there, you see that we're kind of one of the highest in the world at the present time. The US went through their corrective phase, and so they haven't gone up as much over the last couple of years. They have seen growth because of a similar dynamic, but mortgages in the United States are structured a bit differently. They're based off the long end of the market, and so it's a little bit different from a structural perspective. But Canada's housing market has grown so quickly, and I think it's a real risk. And so when we talk about raising rates 5 or 6 times in Canada, I guess if they want to take the air out of the Canadian economy completely, they can do that. But I think it's pretty close to impossible at this time. So it's something that I'm conscious of, and something that I think plays a material part for what happens to Canadian equity markets this year as well. And so just a couple more points on debt in Canada. And so I think this is important because, I've had a number of conversations with clients just saying, why are they talking about this, the economy being overheated? And I think that it is, it's a bit of a misnomer because it isn't. And so they're talking about raising interest rates because the economy is overheated. Well, where those growth areas are coming from is primarily from debt and leverage in Canada, well, everywhere in the world, but because we live here, it's an important thing that we need to be conscious of. So, this is the Canadian debt as of Q4. This was Q4 of 2021. So we saw an explosion of debt refinance with worries about rates going up, and so this is just a view at the Canadian debt markets. And so if we look at that breakdown of what it looks like in US, so this is a US slide because I wanted to look at the US kind of debt levels because it is talked about a little bit as well. So when we look at the breakdown in the United States, it's a little bit different structurally, but certainly worth paying attention to. So you're looking at somewhere close to $4.5 trillion of non-housing debt in the United States. And you're looking at a couple $1 trillion of that is student debt. And the other big chunk, of course, would be auto loans. And so we'll have some discussion around what's happening in the auto market. And then when you look at it as a total, again, non-housing debt and housing debt, you've had a big explosion again in both debt levels in the US. And so why is all of this information relevant? Why do we care? Well, this world has been built on debt from all levels, from the government up to individuals. And so as a result of that, it continually is a challenge for rates to go higher. So with these view that we're going to go 4, 5, 6 times from a rate perspective, I think it's pretty near impossible. The only way we've had the kind of the growth sustained is because rates have been close to zero. And if we look at some of the other countries in the world that got into a similar place like this, like Japan, rates ended up being kind of pinned at zero. Well, they have been pinned at zero for the last decade in Japan, and they're able to continue to survive because there's no additional costs above the current debt they have. So, debt levels at zero while you can continue to finance it and fund it. So I'm not sure that there's really much chance that you can see rates go higher. And why that's an opportunity is because if I'm right and rates only go up once or maybe twice, there'll be a big repricing of bonds, and you'll get a pickup and a really nice return from bonds within the portfolio. So the other component to this, of course, would be inflation. And so the world over is saying we need to worry about inflation. Inflation's the big issue here. Well, as I've mentioned on my weeklies and a number of calls with clients, inflation is slowing down already. And so if we look at this, ECRI, which is Economic Cycle Research Institute, they project that CPI is going to be at 2% by the end of the year without any tightening. And so as we think about things, we have to pay attention to what's kind of in front of us. And the challenge is we oftentimes get stuck at what happened behind us. And so, inflation's going down, growth's going down. Like these statistics are certain. So as we look at it, these are some of the things we think about. So as I mentioned to this, inflation looks like it's rolling over. Car sales looks like it's peaked, rolling over. We got massive negative real yields, which I think is here to stay. ISM showing that things are rolling over as well. So I'm just going to zip through a few of these. And so, as I mentioned earlier in the conversation, talking about the fact that liquidity is being pulled out of the system, this is just a look at really kind of the lack of liquidity that's going to be in the system here. And if we look at the numbers here, this is $1.3 trillion that's being pulled out of the system, and most of that's coming in the first half of this year. And so this is a pretty dramatic reduction in spending or support, we'll say, for the general economy primarily in the US in this case, but we're seeing a similar setup happening in Canada as well. And not so in some other parts of the world like China, which we'll touch on briefly, but that's what's happening right now. And so I've had a number of conversations, and sorry if I'm going a little bit quickly here, but I realized that I'm droning on a little bit. So when we look at GDP and inflation, the question I get is, where do I get those numbers from? Wanted to put them out there. We're seeing, this is US Q1 of this year. We're seeing about a 40 basis point slowdown in GDP. Q2, we're seeing another 1.3% slowdown in GDP. We see inflation again going from 6.5 to 6 to maybe 5 or lower. So this is US data. So if we look at Canada, again, similar data, we get GDP slowing down. We might get a pickup in Q2 potentially. If the US continues to slow down at this pace, I don't think these numbers will play out this way. And then again, we're seeing a further slowdown. Same would apply from an inflation perspective. So this is Canadian data. So we see inflation slowing down here as well. And so, you know, this is one of the things and one of the kind of the interesting research, and I've showed this to a few clients, but, you know, this is what HedgeEye gives me, real-time data on anything and everything. So any country we want to look at what's GDP and what's inflation. And so this is a look at kind of the world CPI. And you see GDP slowing and you see inflation slowing. Again, all of this is without central bank intervention. So, you know, if we get that further central bank intervention, you know, we're going to slow faster. And so the pace at which they tighten, it increases the pace at which GDP slows and inflation slows. And so I think that, you know, the current forecasts are way off base. So this is just to look at the numbers from another perspective. And then if we look at, you know, kind of where the opportunities might be in all of this, you know, this is US slowing down. This is Canada slowing down. And then if we look at kind of the other dynamic in the other part of the world, which I've mentioned on my calls and my comments, is what's happened in China. And so, you know, China, I think, saw kind of a material slowdown at about this time last year. They went through a lot of that pain. Actually, it was a little bit later. It's more like April time frame where we started to see the market roll over. Their economy came under pressure. Real estate market came under pressure. And so they had tightened rates. They tightened rates a couple of times, even though we were seeing a commercial real estate panic. And so it appears now that they've gone through the majority of the worst of that, and so we're starting to see some positive signs. They cut rates, you know, turning some liquidity back into the banking system, and we're starting to see a reasonable pickup there. And I think, you know, China could surprise to the upside this year. And so I think there's an opportunity. And as we look at, you know, kind of the data, we're seeing a pickup and a real positive signal for how that could play out in China. Obviously, a lot of volatility, a lot of risk, but, you know, some of these companies like the Alibabas and some of the big Tencent companies of the world, you know, are down 50-60% from their highs. So presenting some unique opportunities if you can look past the next couple of weeks. And so, you know, as a lot of economists look at, you know, they want to see rates kind of normalize, and I don't think that we ever get to that point again. And so as we think about where yields are going, every time we get into this period of an economic slowdown, we see yields try to come up, and then they put too much pressure on the economy, and they push further to lower lows, and that's a result of the massive debt that we have in the world. And so this is a view at how that's happened and how it's played out, with these red lines being kind of the recession. So right now it looks like, you know, we're seeing the 10-year kind of move up, and it's putting pressure on the economy right now. And I'd expect, again, we get lower lows on the US 10-year and likely the Canadian one as well. So as we think about you know the central banks and how they play a role, you know, this is just an interesting look at, you know, there's kind of a multiple periods where we've entered the kind of environment we're in right now. And what the central bank did in the 40s was they went into kind of yield curve control mode. So inflation was kind of running up, but they pegged rates at a certain level so that rates couldn't move higher. So, you know, it is something that I think about and something that could potentially play out this time. They haven't got there yet, but if they did, I think that level that they peg the US 10-year at is materially lower than where it is today, probably 1% or so, which would be a material capital appreciation in bonds. So if we take a look quickly at Japan, as I mentioned this, Japan tried to raise rates, they couldn't, tried to raise rates, and essentially they've been kind of stuck at zero now for a decade, and that's because the massive amount of debt they have, they're in that period where they can't raise rates, and I think they're stuck there. And there's a risk that that happens in North America as well, and something to be conscious of. And so when I'm constructing portfolios, these are all the things that go into the inputs and the decisions that I think about as I'm getting there. So I'm trying to diversify the assets and risks, take a look at what's happening in the macro and adjust with that. And so it's a continual adjustment for what and where and why do we hold certain things within the portfolios. And so if I'm to give you my view on where we are and where I see the opportunities, at least short term, is we have government bonds, US dollars, gold, as I mentioned, utilities, consumer discretionary. These are some of the areas that provide, I think, reasonable risk return for the first quarter. And so I think there's certainly something to be conscious of and think about. This is Hedgeye's breakdown on how these different asset classes perform over the different cycles. So, certainly happy to send the presentation out afterwards, and you can go and ask and some more details around some of these things. And so I think there's a big gap between here and June, but I do like to certainly provide some thought around what happens on the other side of this, because growth and inflation are slowing right now. And so I think that has an impact on things. There's money to be made, but not in places you made money last year. And so as I think on the other side of this, I'd expect we see central banks cutting rates this year, given what the data is saying. And so when they come to the realization that they can't tighten and they start cutting, I think that's when the opportunities are presented, where we see the market down a reasonable amount, like 20+% or so, at least in the S&P 500, or you can look at some of these names and look at some of these companies that provide really great risk reward over the next 12 to 18 months. So these are some of the areas where I'd see it: small caps, high beta, crypto, things like that. And so I will provide a bit of comments around crypto, because it's certainly something that I continue to pay attention to. I do think it is kind of this blockchain is the evolution of Web3. And so, we talked about to Bitcoin last year, so I won't go into too much detail on Bitcoin specifically, but you've continued to see it gain traction. It's 1.72 trillion of the crypto market is as of right now. We've seen ETFs launch. We've seen kind of a whole trading system and platforms built around it. Fidelity comes in and comments on it daily. It's an asset class within their IRAs and 401ks. So, we've seen it really change dramatically. And as a result of that, I think we do need to think about it a little bit differently, but it's certainly gained a lot of mainstream attraction. And so we've seen lots of more companies added to the balance sheets. And so, as we think about it, this is Kathy's view on where it fits into the kind of the overall picture of it. And so I thought this was an interesting look at it, because you get a breakdown of where it could be used. And so we've seen obviously a few nation states come: El Salvador, Turkey's talking about it, Argentina. Some of the more challenging countries from a fiat perspective have looked at implementing this into their central banks. And so it's interesting to see the potential. Obviously this is an aggressive view that you can see Bitcoin at 1 million, but it's an interesting perspective on how this decentralization is really changing the way people think about things. So from a 2021 perspective, it really was the year that Ethereum gained a lot of attention and traction. And so Bitcoin, where it was built kind of as a store of value, that was kind of the thinking from Satoshi when he built it, where Ethereum is more kind of the blockchain that a lot of things got built on. And so you've seen a lot of attention, a lot of attraction come to it. And so they're quite different from a structure perspective. And so as I think about it, I think that Ethereum is much more of a utility, where Bitcoin is much more of a kind of an investable asset from that perspective. So we'll see how things move along, but continue to pay a lot of attention to this space. And I think people still don't completely understand the potential for it. But Ethereum is really that smart contract that, how do we buy and sell certain things without an intermediary, kind of moving towards like real estate tokenization, things like that. So still lots of technology, I think, will play a major role in what kind of the first turning looks like on the other side of this. The other two that I'll comment on in kind of the crypto space are DAOs and NFTs. I mean, NFTs are non-fungible tokens. We did a whole podcast on that. If you haven't seen it, certainly please go have a look at that. It's a great description of what they are, who they're for. And so what's interesting though is the majority, as you can see from the chart here, the majority of the NFTs are built on Ethereum. And so as we've seen that platform develop and evolve, it is starting to continue to gain a lot more attention. And so why did I talk about kind of the demographics changing, and what do I think about where we're going? So as I sit here and I think about being a portfolio manager, somebody that manages money in private markets, if you'd asked me 5 years ago that I'd be talking about NFTs and DAOs and blockchain and crypto, I would have told you you're crazy. But as I think about how people are saving money now, where a lot of the kind of the attention is going, is it's going into kind of a quasi investment world that looks a lot different than the one that I knew for the previous 75% of my career. So we've moved into the world where millennials are much more interested in being part of an alternative kind of investment set. And so I think that things are evolving, and these DAOs are like decentralized autonomous organizations. So you'd get people kind of all over the world participating in kind of their own corporations. They'd get shares within their own corporations. They'd work together to form these kind of unique structures, and with that they'd get some currency, cryptocurrency, that they could buy and sell certain things digitally. And it's been a massive place that people have been investing their time and money, and institutions as well have spent a pile of money and attention towards investing in kind of this future evolution of technology. So still gets a lot of the time and attention, still a small piece of your portfolios, but one that I do think that has the chance to go up 5-10 times from here and could provide unique opportunities. And so that's why I continue to look at it from a long-term investment perspective. But we also have to realize that with that comes increased volatility. We need to pay attention to the timing of why and when you own these certain things. And that's when the macro comes into it. So when I think about composition, I do think about where are we in the cycle? What are the potential risks with owning these given where we are in the cycle? And I go back to looking at what's our timeline and views on these things. And so if we look at these charts, this is a logarithmic chart, kind of long wave since Bitcoin started, and these are the trend channels within that. So we're somewhere around 1 standard deviation right now from the mean, and you typically move to kind of 2 in a worst case scenario. You move to 2 standard deviations above or below the mean as we move towards kind of that higher level and that kind of evolution of where it looks like it can go. So based on kind of these long-term channels, we still, from a technical perspective, still look like the direction continues to be sound and stable, and something that continue to watch on a longer-term basis. The other thing, of course, is the drawdowns. So we had pretty material drawdowns early on in Bitcoin before we participated. But as this becomes institutionalized, as the system changes dramatically, your volatility actually has come down, and likely to see the drawdowns be less dramatic. And that's typical as things evolve in the system, kind of this S-wave network theory. And so interesting to continue to follow that. these are some of the charts that I pay attention to when I'm looking at where we are and what should we do. And so if we look finally at present day Ethereum, if we look, there's a lot of technical indicators that a lot of people look at, but this is a comment from Raoul Powell. He looks at a lot of different metrics, but certainly appears that we're in that zone where it looks like there's a lot of support and something to be conscious of when we're making decisions within where it fits within the portfolio. This is a long wave on Cathie Wood's ARKK, so similar, just taking a look at the longer term patterns and recognizing that she, again, as well as at the lower end of her band. And so, if you're patient, you have a longer term view, I think there's a lot of opportunities that are going to be presented themselves in the next 2 to 4 months. Oftentimes, too, we talk about central bank digital currency. This is going to be the last thing that I hit on before I wrap up and see if there's any questions. And so, they're really different, but we've seen a massive amount of attention come to central bank digital currency over the last few years. We've had a bunch of countries launch them. China is kind of really close to, but we've seen like the Bahamas, they have the sand dollar. We've seen Nigeria and a bunch of other countries come up with a central bank digital currency. I think this is going to be a big change and something that I think people are much more comfortable with now that they've had to move into a cashless society. So this is kind of, continuing to evolve quite aggressively. And if we look at it visually from around the world here, we've had 9 official central bank digital currencies launched. We have 14 kind of in the pilot phase right now. And we have another 16 in development, another 41 kind of in that research phase right now. So, the central banks, whether they say it overtly or not, are embracing this. And I think it's something that we need to be conscious of and look for some opportunities, because there's some stocks and there's some companies like Overstock, for example, who have a division where they've providing the blockchain for these central bank digital currencies to sit on. So interesting, the world is embracing this, and it's trying to be thoughtful around where the opportunities are and how do we best position for those opportunities as we move ahead. So as we wrap up here, I continue to look at how do we get better? How do we make better decisions for you to ensure your portfolios are stable, prepared for growth, and continuing to grow on a consistent basis? And so we're always looking to do that. This last year, as I go through it, typically thinking about how do we make better decisions. One of the things that I take away from this year is, in some cases, it didn't aggressively sell as much from the perspective of worrying about triggering capital gains. And as we look back on how things have played out over the last 6 weeks, that's something that I take into account as I look at making decisions as we go forward. And so as we wrap today, as I mentioned, these were the 2 quotes that I think about when I'm structuring your portfolio. Is how do I make sure I'm positioned for what's ahead and not be so focused on what happened behind you? And so one of those unique challenges is that we're looking ahead, we're basing the decisions based on what the data is telling us, and we're trying to make sure that you're positioned for that. So maybe you own bonds in US dollars right now, which wasn't the right thing the last little while, but based on what the data is saying today, that's going to be a real positive contributor as we move forward, because growth and inflation are slowing. And so this is a very important time to think about how do we protect and preserve and make sure we have those counterbalances that can support the portfolio right now. And the other is, as the market shakes like we've seen, NASDAQ's down about 20% from its highs first week in November. Russell's down 20%. Like, these are pretty dramatic drawdowns. And I think it probably gets a little bit worse in those sectors. So that's going to present tremendous opportunities over the next 12 to 18 months. So I'm thinking a lot about, let's have some stability in bonds that provide that protection, that go up in value. We'll have the ability to sell them and pounce on some great opportunities that that are presenting themselves here over the next little while. So I want to thank you all very much for taking the time to listen to me. I see here that I'm a little bit over an hour now, but tried to race through it. Probably a little bit quick in some areas. I apologize, but I wanted to get as much information and thought around what's happening, where we're going, and how I think we can be best positioned for what's coming. So, Scott, don't know if you want to jump back in here and see if anyone has any questions for us.
Yeah, it looks like we got one from Lyle. Couple here. All right. Okay, Lyle says, what are the selective best indicator factors, metrics, drivers that you monitor and that can provide insight on what is happening in the markets now and going forward?
Yeah, so what is I guess a handful of indicators, and so I would say there's a couple. I think I guess economic numbers are something that we would follow from the macro, but from a market perspective right now, I would say that we certainly need to think about, each day I would look at and say, what's volatility doing, which would be a major input. What are volumes doing in the different environments? So if we have a big down day, are volumes down or up? If volumes would be up in a big down day, that's a bad sign. If we get kind of a big up day, and again, volumes are light, that's a bad sign. So I'd look at probably volumes and volatility and see kind of what the action is happening there. And so that'd be market related. And then I'd say from a technical perspective as well, I'd be looking at support levels and some of the different indices, including gold, of course, and saying, what's happening there. But from a market structure perspective, those would be a few of them. And I guess the last one would be, as we see kind of, the markets, any kind of market, stocks, bonds, commodities, move to kind of, if we reach kind of lower highs, that's a signal that there's something kind of fundamentally wrong with the market. And so those would be a few things that I'd look at.
Okay, great. And then we just have a comment from Dave here. Great presentation. The pitch and charts are largely driven by historical patterns and economic data. Aside from an oblique reference, there's no analysis of the impact of a major confrontation in Europe triggered by Putin, which led for the most part of the economic warfare, not military. Example, e.g. cutting oil and gas supplies, cyber attacks on infrastructure and communications to cut off transfers and transactions between North America and Europe, etc. So I don't know if you want to comment on that or.
Yeah, so that's definitely all great points. Most of those references are kind of tail risk references, and so from a event like that where there is a supply shut off, for example, that would certainly be a tail commodity risk. And so that could throw the inflation metrics offside as well. And so maybe we do get a hotter inflation print as a result of that. And maybe we potentially get a rally and further rallying commodities, particularly natural gas, of course. As for the military confrontation, the assets, again, that would perform the best in a military confrontation would be US dollars and US bonds. You'd get a flight to quality. You'd probably get a bit of a knee-jerk reaction to that. So positioning there, we have some tail protection built into that. From a cyber perspective, I think that continues to be a material risk globally. I think that part of this decentralization thinking, which while it's still extremely early days, is specifically related to dealing with those kinds of events where you don't have a central control, which is what we have now. Like most things clear through banks or SWIFT or some kind of central clearinghouse, and where you get a kind of a cloud decentralization that the world is thinking about. That's potentially something much for the future, but part of why I think people are thinking that way. I think in any of those events where we get a kind of a war shock, money flows to the high quality, the most high quality assets. That'd be US dollars, US treasuries, and gold right now. And that would be something that would be into portfolios to prepare for any type of event like that.
Okay, great. Those were the two that we had. I think that's it. Yep, looks like that's it.
All right. Sounds good. Well, do you have any questions? Anything come up? Anything interesting?
That was I think that was a world record for most slides gone through in 1 hour.
Maybe too quick.
That was great.
Maybe too quick. Yes.
Yeah, it was great. I think it really shows the thought and attention that goes into every decision that you make. So I think it was great. It's always good when people get to see kind of inside that decision-making process and what leads you to and how you're managing the portfolios. So I think it was great.
Yeah, for sure. For sure. Good. Well, did anything else? Any other questions before we go? We're good.
Well, wants to know how many gold medals will Canada win in Beijing?
Hopefully a lot. Hopefully a lot. I'm most hoping that the men win the gold medal in hockey, especially because they got that mixed group coming in. So
it's gonna be tough against all those KHL guys from Russia.
It's true.
Tough. Even the Czechs have a good league over there, or Swedes have a good league over there too. So those pro leagues are pretty good.
Exactly.
Yeah.
Well, I hope a lot. I hope a lot. Well, listen, if anybody has questions that comes out of that, we certainly can send out the deck. I know there's a lot of charts in there, so if anyone wants that, let us know as well. But appreciate you taking the time to listen tonight and listening to where and what I think about where things are going. And so I appreciate that and look forward to continuing to work with you to get you to your goals in 2022.
Great. Thanks, everybody.